LMI, we don't have to pay it in the UK. And I did feel like it was a bit of a con, to be honest, coming here, because we didn't have to pay it in the UK. But here, if it's under 20%, you have to pay LMI. Can you tell us more about the LMI?
Yeah, sure. So essentially what mortgage insurance, or LMI as it's referred to, it's an insurance premium that is passed on to the customer that protects the bank. Okay, so essentially what it does is it insures the loan in the event that you as the borrower default on the mortgage. Okay, so the banks see it as they're taking a bigger risk because you don't have much of a deposit, so you have less skin in the game essentially. So anything sort of less, in rule of thumb, let's say, of less than a 20% deposit, you're going to have that mortgage insurance premium that you have to pay. The bank typically, it's generally charged at around between 1.5% to 2%, depending on the loan amount and loan to value ratio as well. So if it's a 15% deposit, or if you've only got a 10%, it's tiered in that way. But the bank will also lend you that money as well. So if it's, let's say you're borrowing 800,000 and the mortgage insurance is, let's say, 13,000 or 15,000, the bank will allow you to actually put that on top of the mortgage, so they'll lend that to you as well. So you can borrow that funds, provided that it still sits within the acceptable bands for the bank. So look, I get it, like I sometimes classify it as almost a necessary evil, because what it does is it allows people to actually get into the market much faster, okay? Because you got to think about, well, how long is it going to take me, again, if I want to borrow the $1 million or buy the $1 million property, and I don't want to pay mortgage insurance, and I've got to save 200 grand plus my 40,000 on top of that for the stamp duty, versus I have 100,000 and I can cover my stamp duty. I have 10% and I can put the mortgage insurance on top of that.